Imagine finding your dream home and then losing it because your finances weren't in place. Welcome back, week 2. We have Jacob join us today. Know before you go. That's the topic of discussion for our mortgage podcast for this week.
Know before you go. I love that. I'm sure I'm going to be talking a lot about due diligence in this episode. It's something that I love to do upfront for my clients. Applying for a mortgage is a very paperwork intensive and can be a strenuous process, but it pays dividends later on. We have one of the lowest arrears rates in the developing world because we have some of the most stringent qualifying guidelines of any country in the developed world as well. There are a lot of hoops we have to jump through and a lot of compliance boxes that we have to tick as far as anti-money laundering guidelines and FinTrack guidelines to make sure that we are doing our jobs properly. But at the end of the day, it's there to protect the average Canadian consumer. So doing our homework up front and making sure we're prepared when going into an offer should be, mortgage 101 and is a very basic part of my job and something that I really love to do to help and protect and empower my clients.
Jacob, let's demystify this pre-approval process. Walk us through the importance of having a pre-approval before you go in for the offer, and especially bearing in mind in today's competitive market.
For sure. So a pre-approval is a very important first step when you're looking to purchase a property. Essentially, a pre-approval is having a mortgage professional look through your financial picture in detail so you have as much certainty as possible that when it comes to actually funding the mortgage, when you close on the property after you have your offer accepted, that you have as much certainty as possible that the mortgage will be funded and there'll be no hiccups along the way. A pre-approval involves your mortgage professional reviewing income documents like pay stubs, T4s, employment letters, down payment documents such as bank statements, and anything else to do with the property specifically that you might be looking to offer on. Like if it's a condo, we're reviewing property taxes and maintenance fees to make sure that that still works within what you should be qualified for when it comes to actually funding the mortgage. The importance when it comes to putting an offer in on a property is that you never want to offer on a property if you really don't know that you're qualified for the mortgage itself. And the more due diligence that your mortgage professional does upfront during this pre-approval stage, the less chance there is for any last minute surprises or hiccups when it comes to funding the mortgage. When it's a competitive situation where there are other people offering on the property and maybe there's a bit of a bidding war, it's very important that you know what your maximum offer could be on that property. And getting a pre-approval is really the best way to figure out what your budget is and what your maximum offer could be on any given property.
It's interesting to know. So what's then the difference between a pre-approval and a pre-qualification?
Great question. So a pre-qualification is typically what I do with my first clients during our first consultation. We'll have a phone call or we'll do a Zoom meeting and I'll ask my clients questions about their financial situation. We'll talk about their income and employment. We'll talk about their down payment. We'll talk about anything that they know about their credit score and credit history. And then using that information, typically by the end of the call, I can come up with a rough budget and say, based on the information that you've provided here, this is how much I think you can qualify for. That's basically a pre-qualification. I haven't reviewed any documents. I haven't done a credit check or anything like that. The next step is a pre-approval. That's when I collect documents in an application if the clients haven't submitted an application already and pull credit as well. Using all of that information put together, as I mentioned earlier, that's when we can get to the full pre-approval. And that's where we have certainty going into an offer that there should be no issues funding the mortgage. A pre-qualification is a bit of a softer kind of conversation, exploratory kind of thing. And the pre-approval is definitely a lot more firm and gives you the confidence to go into putting an offer on a property.
I love this next one. A lot of people ask me this, but it's almost like saying, how long is a piece of string? I know that we cannot commit to a specific time, but typically, how long is a pre-approval process? How long does that take?
Yeah, so when I first meet with my clients, my initial consultation, if we can start on collecting documents in an application immediately after, typically I can turn around a pre-approval in 2 to 3 business days. It really depends on how motivated the client is to move forward. If you're able to get documents to me that evening or the next day, I can start reviewing right away. And again, turn it around in 2 to 3 business days. Some people like to take more time and maybe it could take up to 5 to maybe 10 business days, especially if it's a more complex situation. I might review everything and get back with a few questions and maybe ask for a few additional documents. And all the due diligence that I'm doing upfront is really to benefit the client later on in the process when it comes to being confident putting in an offer not stressing on closing day. So it really depends on the speed at which the client is moving and how motivated they are. But I would say minimum turnaround time, and it depends on how busy I am and how busy the staff is, but typically 2 to 3 business days. If it's more of a simple kind of cookie cutter first time buyer situation, it could take 1 day of reviewing documents, and I'd get back to the clients in that time frame.
What's some of the key areas that lenders look for in terms of qualifying you for your pre-approval?
Yeah, great question. So lenders look at three main factors in your financial picture when they're qualifying you for a mortgage. The first, and by far most important, is your income and employment situation. Essentially, how much money you make directly reflects the amount of mortgage that any lender is willing to lend to you. And the nuance of your income situation as well. Are you a salaried employee? Are you an hourly employee? Are your hours guaranteed? Are you self-employed? How much income do you declare? All of these things and all of the answers to all of these questions will determine how much a lender is willing to lend to you. The second factor is your down payment. So how much you have saved up that you're looking to put into the purchase. This could be, borrowed funds. This could be gifts from family members. This could be obviously your own resources and savings and investments. And this is something that I like to break down on a granular level when I talk to my clients, because the source of the down payment really does factor in to which lenders we go to and how we present the file. Because the more I know about the sources of down payment, the better I can position the application, and obviously the higher chance of approval in that case as well. And then the third factor is your credit. So your credit score and credit history, basically how much credit you currently have and the different types of credit you have and how you've handled them in the past is going to show the lender your credit worthiness and determines what they consider as far as are you going to be able to make your mortgage payments on time in the future. So reviewing credit and talking about your credit and credit history is a very important part of the process as well. If I pull your credit and something comes up that we're not expecting, it's good to do this early in the process so that we can mitigate any issues. Maybe there's something that's reporting falsely on your credit or something that needs to be cleared up with Equifax. We can do that in advance of you offering on a property, deal with that upfront so that it doesn't become an issue later on in the process.
So often in pre-construction, we know and we hear that once you're pre-approved, you're done, it's dusted, it's a done deal. That's a myth. Does the pre-approval guarantee your mortgage?
Yeah, that's an interesting question, especially with what we're seeing in the market today. The builder, in most cases, requires a pre-approval letter for you to make a purchase, sometimes before the property is even, construction is even started. And the idea is that should you be pre-approved for the property or for the mortgage that you need at this point, before the property is built or before you're closing, then ideally you will also be approved once the property does close. But sometimes we see timeframes of 2, 3, 4 years between the point of purchase and the point of actually closing and needing that mortgage once the final closing date comes around. And lots can happen in 2, 3, or 4 years. People's employment situations can change, credit situations can change, your relationships, between partners and spouses can change. So being pre-approved today is great, but we don't know what's going to happen in the future, obviously. And so any type of, builder pre-approval or pre-construction pre-approval should come with a disclaimer saying we still will have to do some kind of due diligence once it comes up to final closing. And different lenders are different. You can talk to the financing partner at the builder as well. And sometimes they'll do a pre-approval that will be valid for 4 years, and you won't have to be pre-qualified or qualified again, rather, once it comes up to final closing. So it's important just to do your due diligence on exactly what the mortgage requirements are now and what they could be in the future. And just know that should things change in your financial situation, you just want to make sure that you can make those payments as well, regardless of whether the lender is going to approve you. You want to make sure that you are comfortable with those payments when the time comes to actually make those payments. And of course, nobody really knows what's going to be happening in 2 to 3 to 4 years from now. But of course, we can, be as prepared as possible and do as much due diligence up front to make sure we are prepared for that point. But a pre-approval at this point is just that. It's a pre-approval before you actually need the mortgage. And when the final closing comes around, that's when the actual mortgage needs to be funded and registered on the property with you as an owner.
So a keynote is make sure you get your pre-approval in place before you start going shopping and you found the one.
Yeah, absolutely. I mean, there's nothing worse than getting to the point of finding the property that you love and then realizing that you can't actually qualify for it, or you need to take longer to get your qualification because you didn't do that pre-approval in the first place. The realtors that I work with make sure that their clients get pre-approved as one of the very first steps before they go shopping for properties. And that's, of course, the best way to do it. And you should have a mortgage professional on your side who's ready to do that for you in advance of finding any properties so that you are prepared, keeping your mortgage professional in the loop as you go to see a property. If something looks promising and you're deciding you may put an offer, keep your mortgage professional in the loop so that they know and they can be prepared to submit for approval as soon as you get that offer accepted, because timing is very important, due diligence is very important, and making sure that you're in the position to make that offer confidently when you do find the property that you love, also very important.